In this video, I'm going to show you the exact analysis that I use on a daily basis and the analysis that has made me well over 6 figures in the past 6 months. Please understand that it took years and years of sacrifice and hard work in order for me to be able to make this on a single trade. So before I go ahead and break down exactly how I made $3,000 in less than 30 minutes, please understand that it is likely going to take years of hard work for you to be able to replicate this into your own trading. You must always remember to never compare your chapter 1 to someone else's chapter 10. I have founded my own private trading community where I share daily and weekly outlooks, live streams with live trading, webinars, charting sessions, and much more. I've personally helped over 300 traders come closer towards their financial goals in terms of trading. The link will be in the description of this video if this is of any interest. Quick reminder, you don't need any paid education in order to succeed in any industry. It just makes everything go a little smoother and faster with the right guidance. All right, what's going on, guys? So before we actually dive into the technical part of this video, I quickly want to go over my risk management approach when it comes to my funded accounts. A lot of people view risk management differently when it comes to funded accounts specifically, but I'm going to go ahead and show you exactly how I view my own risk management and how I approach every single funded account. So firstly, it is very different how I treat evaluation accounts to live funded accounts. This is from a futures funded account perspective where the drawdown is typically 6%. So on evaluation accounts, I will do 1% risk on every single trade until the account hits a negative 2%. Once the account is at a negative 2%, I will use 0.25% risk until the account is back to break even, and then I will up my risk to 1% once again. Now, if you feel like this takes too long at 0.25% risk at a negative 2% account balance, well, then you can use a 0.5% risk instead of a 0.25% risk. Now, a lot of people will ask or tell me that 1% risk on a funded account with a 6% drawdown is a lot on evaluation accounts, and I would agree, it is a lot, but my time is money. I like to get my evaluation accounts done with fairly fast. I don't want to spend too much time on them. Now, this totally depends on your financial situation. If you have trouble affording multiple funded accounts, well, then you should probably not be risking 1%. Or if you are new to trading in general and you have not yet passed an evaluation account, I would also consider lowering your risk to maybe 0.5% instead of 1%. Now, when it comes to my personal live funded accounts, my PA accounts, whatever you want to call them, I will use a 0.25% risk until the account is at a negative 1%. When I am 1% in drawdown on the account, I will use 0.25% risk until the account is back to break even, where I will then start using my 0.5% risk again. Now, no matter how much profit my account is in, I will never risk more than 0.5% of my account. So if that is a $50,000 account, which most of my accounts are, I typically will risk anywhere between 200 and 250, but not anywhere above that. As you can see, I tend to take it a little bit more slow when it comes to my live funded accounts, simply because this game is a marathon, it's not a sprint. There's no need to rush. So once I have passed my evaluation account, I will take it slow from there. I'm very picky about the setups that I take. And when I take a setup, it is not using more than 0.5% risk. Now let's talk about the trade framework / plan, okay? So number one, this is very important, time of day. What time is it when you are looking for a setup? Now, most of my setups are found between 9:30 a.m. EST and 11:30 a.m. EST. That is typically when I see high probability setups form. However, it is not the only time where I would look for a setup. I will also look for a setup between 3 and 5 a.m. EST, but I never trade the PM session. As soon as the lunch hour hits at 12, I am done trading for the day, no matter if I'm red, green, or break even. I am simply just not trading the PM session. The only times where I will look in the PM session is when we have FOMC. So at FOMC, I will look at the PM session and potentially look to place a trade, but that is also the only time when I will look to trade the PM session. Other than FOMC, 99% of my setups are either found between 3 to 5 a.m. or 9:30 till 11:30 a.m. EST. Now, the middle one here, which is again going to be the most important one, draw on liquidity, right? What does that mean? Well, simply, where do you think the market will go, or do you know where the market will go, right? That's the draw on liquidity, and that is the most important part of trading. The PDA rate that you're using, if you're using a fair value gap, an order block, a breaker block, that does not really matter. What matters is you know where price wants to go. That is the draw on liquidity. That is the center of it all, the foundation of everything. It all comes back to the draw on liquidity. So that is indeed the most important part of your technical analysis. I'm going to show you exactly in this video how I personally find the draw on liquidity on a lower time frame, because a lot of people seem to be looking at the daily chart, the weekly chart, or even the monthly chart when it comes to their draw on liquidity. But I have a very, very different view on this, which I'm going to break down in this video. Now, the last one is your entry criteria, your entry model, what PDA rate has to be present in order for you to get in. Now, this is very individual. I personally am a turtle soup trader. I need a high to be formed inside of an imbalance. If that happens, I am inside of the trade. Either that, or I will usually get my trades off of optimal trade entry fair value gap. So those two PDA rates or entry criteria models are what I look for before I enter a trade. And again, I'm going to show you exactly what I mean on a chart here in a second. But these three things are the most important things when it comes to planning your trade, or things that you have to have in check before you actually put on a position. And it is just so important. So let's jump onto an actual chart and let me show you my analysis on a live chart. So here we are on a chart on the NASDAQ from Monday. This is a trade I took with the team inside of the private community, and I'm now going to be breaking down exactly what I saw, because it is a pretty good representation of what I look for on a daily basis. Now, to understand this, we must go to a higher time frame and look at this 12-hour imbalance, which we have right here. Now, at the time, that 12-hour imbalance had not been hit yet. These equal lows here, this low and this low, represents the 12-hour unmitigated imbalance, which basically means that price has not visited this imbalance yet. Now, if you know anything about ICT, you should know that the market is attracted to either liquidity or inefficiencies. Now, a 12-hour imbalance is quite a large inefficiency, and I therefore really like to use imbalances that have not been reached yet as my shorter term draw on liquidity rather than actual liquidity. So I saw that on a 12-hour chart, we are inside of a very, very bullish market. Now, the chances that we go to this 12-hour imbalance are very, very high. Now, I have to pay attention to the S&P 500 at the same time, right? That is a correlated pair to the NASDAQ. So if the S&P 500 had hit this imbalance, then maybe I would not trust it as my sell side objective. But here on Monday, the S&P 500 had not hit this 12-hour imbalance either. So I was confident that that was the sell side objective for today. Unfortunately, I got to the charts at 9:30, which is right here, and I didn't really get an opportunity to take a short down towards this 12-hour imbalance, even though I knew exactly what was going to happen. But what ended up happening instead is that price jumped down into this 12-hour imbalance, and I knew that, okay, now my sell side objective has been hit. We are likely going to get a retracement towards some sort of buy side objective now, whether that would be an imbalance or liquidity. In this example, I noticed that we had very, very clean equal highs being made right here, right? Because we have a high here, we have a high here, and we have a high here. So that is something I pay a lot of attention to. If we have hit my sell side objective, especially if that objective is an imbalance, I am now going to anticipate that a buy side objective is going to be the next target for price, because we have just reached the sell side objective. So hitting a 12-hour imbalance, right, in a overall bullish market, we now have equal highs here. So I am pretty confident in knowing where price is going to go next, and that is going to be these equal highs. So all I had to do was look for an entry. Now, I actually took two trades here, and the first one was a loser, but a very, very small loss, right? I'm going to tell you exactly what I saw. So I actually bought the market as soon as we swept this low right here on the 1-minute chart. Now, this is my exact model, which is why I was willing to give it a try towards these equal highs. Now, I said to the team, I am well aware that this is a risky setup, but I'm very confident that the market is either going to reverse off of this annotated low or this annotated low. One of these two is going to reverse the market and take out these equal highs, but I was not very confident in which one it was going to be. Now, I knew that this one down here was going to be a higher probability play, but because I also thought that the market had a potential to reverse off of this imbalance, I decided to take a play here with my size significantly lowered. So that is something I will often do if I have two places on a chart where I think price can reverse off of. I'll actually enter a trade in both locations, but the first one, I lower my size significantly so that if it is indeed the first PD array or point of interest where price is going to reverse from, I still make money. Obviously, I don't make as much because I'm going to lower my size, but I still make some. And if it loses, well, then I'm going to lose not a lot, right? But on the second entry, which is this low here, the one that has a higher probability of working, I am there going to go in with my normal size or even up my size if I am very confident. So the first setup looked like this. I have my stop a bit above these lows here, which is something I will often do. A lot of people will ask me, well, why do you not put your stop all the way at the low? And my answer to that is I can place my stop a little bit above the low and save myself 50, 100, 200 bucks by doing this. Because if we end up coming down here and stopping me out, the chances of us going to this low is almost 100%. And I would rather save myself 100 to 200 bucks by putting my stop a little bit above the lows. So this right here was the actual setup, and you will see exactly what happened. So as you can see, I got stopped out instantly, right? But I was completely fine with that. Now, the next entry was obviously going to be this annotated low. Unfortunately, I didn't get to take the setup myself because it all happened a bit too fast, but I was still very confident that this is where the market would reverse off of. My entry was going to be a bit below the low, and my stop loss was going to be the mean threshold of this order block right here. So this is exactly what the trade would have looked like. And some of the members actually ended up getting this very fill, which was very, very nice. Now, as you can see, we got very close to getting stopped out, but this order block held to the absolute T because it was also supported by optimal trade entry of this trading range. As you can see, optimal trade entry aligned very well with this order block. And therefore, I wanted to include at least half of that order block in my stop. The way I view my stop losses are pretty simple. I simply place my stop in a place where if price goes there, my initial analysis will be invalidated, or the PD array that I'm entering off of, or the idea that I'm entering off of is no longer valid. And at that point, I'm gambling, right? So I said to myself, if we go to the mean threshold of this order block, my analysis is probably wrong, and therefore I placed my stop there. Now, again, unfortunately, I didn't actually get this entry myself, but I got the next one. I said to the team, now, okay, we just missed this move, or I personally did, so I'm going to have to be patient, and if the market does not offer me another entry, I'm simply just going to take it and leave it. But luckily, I said, the next entry that we are going to get towards those equal highs is going to be an optimal trade entry play of the newly created 1 minute range right here. And that is exactly what I did. So my entry was actually the OTE of this range. Now, again, my stop was a little bit above this low here, and my target was again going to be those equal highs for about a 2.3R trade. Now, let me show you exactly what happened. I actually got filled to the absolute T here. Absolutely beautiful, and I was very, very confident in this play. Now, let me tell you why I was so confident in this play right here. So if we go to a 5-minute chart, you'll notice that the low in where I placed my stop was a low that filled an imbalance, right? We have a 5-minute imbalance here, and we have a low that filled that entire imbalance. Now, it is also a swing low. Now, when that happens, these lows are called intermediate term lows, and this is the absolute best place that you can place your stop loss. Now, the reason for this is because these lows are meant to hold in bullish markets. So if this indeed is the next drawn liquidity, this low is not going to be broken. So when I get a chance to enter a trade where my stop can go at that low or right around that low, those are the setups that I want to take because I am very confident and happy about my stop loss placement. So If the market allows me to get entries where I am comfortable placing my stops at either intermediate term highs or intermediate term lows, those are typically going to be my best setups. So that is the number one reason why I was so confident in this setup. But again, it all just came back and down to knowing exactly where price wanted to go. My sell side objective had been hit, and now I was really expecting us to hit the buy side objective. Now, I obviously will keep paying attention to the S&P 500 and making sure that there is no SMT here. Now, funny thing about this trade, we actually got an SMT at these highs with the S&P 500, meaning that the S&P 500 swept the highs before the NASDAQ. But I told every member inside of the community that the only rule about this position is that you have to go break even as soon as we form a bearish SMT. You either go break even or you take off the entire position. One of the two has to happen, right? So I think it was right around here when we got an SMT, and I actually moved my stop to break even as soon as that happened, because the likelihood of us reversing after an SMT is pretty large. So I always go break even at SMTs, or I take off my full position as soon as an SMT occurs. Of course, here I would not be very satisfied with a 1-to-1 R or a 0.5 R, whatever it is. So I moved my stops to break even, and it ended up working out just perfectly anyway. So here was just an example of a trade that I took in a good representation of trades that I take on a daily basis. Now, right here is another great example of a trade that I will typically take, and actually a trade that I placed again with the community just the day after the other example, so Tuesday. And it actually reminded me a lot of the previous example, because I was also using a 12-hour imbalance as my shorter term drawn liquidity for this trade. Now, the only difference between this trade and the other one is that I actually got to take a short towards my drawn liquidity, which again was going to be the 12-hour imbalance that we had right here. So right at this low, we have a 12-hour imbalance that we have not hit yet. But what caught my eye immediately as I got to the charts, I get to the charts at 9:30 every single day. So at 9:30, what immediately caught my eye was the market maker sell model that we had in play here. So what we want to pay attention to with market maker models is these curves, right? You see the buy side curve here. And if I draw it out again over here, you're going to see a sell side curve. So this is what a market maker model looks like. And when that is in alignment with my drawn liquidity, which was here, right? We have the buy side curve here, the sell side curve here, and my drawn liquidity was going to be this low. I am very, very interested in looking for a short, right? And these are going to be my A+ setups. This is my one setup for life when I can get either market maker buy or sell models towards my drawn liquidity, which I have to be very confident in. That is just absolute perfection. And it is exactly what happened here. The first sell limit order that I put in was actually at this 5-minute imbalance with my stop right at these body highs here. And obviously my take profit going towards my drawn liquidity. Now, I was well aware that I could get left behind by putting my sell limit here, because if I go to a 15-minute chart, you will see that my sell limit is a bit into this 15-minute imbalance, right? So I was well aware that the market might just tap this 15-minute imbalance and then shoot lower. My normal entry would be the 15-minute gap at the beginning of it, but because I was going to enter a trade this close to the open at 9:30, I wanted to get the best possible entry with the least amount of risk. So I decided to put my sell limit order at the 5-minute imbalance instead of at these highs right at that 15-minute imbalance. Now you'll see exactly what happened here. I got very close to getting filled. I was actually about 10 ticks away. Yeah, 10 ticks away from being filled, and then got left behind. So this is very frustrating. And this is when a lot of people will lose money, right? They will chase the market when they miss their opportunity. Now, I did not chase this market. Luckily enough, I waited around for the market to give me another opportunity to short towards my drawn liquidity. And if the market was just going to run down and hit my drawn liquidity without offering me another opportunity to short, I was simply just going to accept the fact that I was not going to place a trade this day. So let me show you what happened on a 1-minute time frame here. Now, I wanted an optimal trade entry play right here, and that was going to be right here. So I was filled off of optimal trade entry here with my stop a little bit below the high, as always, and my target at that 12-hour imbalance, right? So looks a lot like the setup I took in the previous example, only this is a short, the other one was a long. And let me show you exactly what happened. So we got into quite a bit of profit, and obviously everybody thought that we were going to hit take profit here, but the market had other plans. Now it is contract rollover week. So I was expecting a bit of choppy price action, a bit of a flat market. But at this point in time, I had told everyone to go break even or take off your positions, whatever you want to do, whatever your analysis tells you to do that. But I am going to go break even on it because this was about 110 ticks in profit. I'm not going to let a 110 tick green trade turn red on me. That's not going to happen. So I was break even here. And as you can see, I actually ended up getting stopped out break even on this position. Now, this can be very, very frustrating. I really thought that this was frustrating as well. But again, there's nothing I can do. I told everybody I'm going to have to wait. And if the market can give me once again another opportunity to short towards that drawn liquidity, I am going to do so because I'm still very, very confident in my drawn liquidity. So notice how all of this just comes back to knowing where price wants to go. And I am using higher time frame imbalances to know where price wants to go the majority of the time. So again, I waited around and I waited around. I wanted one more optimal trade entry play. And I said, if we return to optimal trade entry now, that is probably the last opportunity that we are going to get at a short towards our drawn liquidity. So I am personally going to take one more short at OTE towards the existing drawn liquidity, which was going to be the 12-hour imbalance if we end up hitting the OTE of this newly created range. And you'll see exactly what happens. We ended up getting filled, chopped around for a bit, and then eventually hit take profit. So again, just using the optimal trade entry, I was able to make money this day. I missed my first entry all the way up here by 10 ticks, right? The second entry, I was very close to getting my full TP, then getting stopped out, break even, but I had the patience to wait around for my setup to appear once again. Now you will see me use optimal trade entry a lot these days, and that is simply just because in the current market conditions, I find optimal trade entry working a lot. So if my setup or PD array aligns with optimal trade entry, I am very, very confident in those trades, but it all again comes back to knowing the drawn liquidity or knowing where price wants to go. So a little bit of an odd ending here, but I hope you enjoyed and I hope this helped some of you out. This is basically how I analyze the market every single day. Now, of course, this is going to change depending on market seasonality. But in this video, I gave you two examples of the last two trades that I have taken inside of my private community. And hopefully you now understand a little bit more how I personally view the market. Now, usually I will get turtle soup entries, meaning that I sell the highs and I buy the lows. But again, recently the market has just been showing me that optimal trade entry is working a lot. So if I can find a PD array that aligns with optimal trade entry of a trading range, I would be very, very happy to use that. Because even though I am a turtle soup trader, I also adapt to market conditions. That is just a part of being a trader. So I really hope you enjoyed this video. And I hope it helped some of you out again. Thank you so much for watching, and I will see you in the next video.